Hello and welcome to today's deep dive. We are looking at a logistics market that is frankly suffering from a serious case of split personality today.
Yeah, it really is.
On the surface, things are going quiet, engines are cutting off for the holidays, but underneath the pressure gauges are absolutely redlining.
Exactly.
Welcome to the TAC Index AI podcast, February 26, 2026, where we blend TAC IP data, reports, and charts with the latest news in all things logistics with a focus on air cargo.
It is a really strange week to be watching the data. We've hit the traditional Chinese New Year lull, so you would normally expect a total snooze fest.
Right.
But instead, we have this massive volatility in energy and trade policy sort of underlining the silence. It feels less like a holiday and more like, I don't know, the eye of a storm.
It really does. And the data definitely reflects that immediate holiday drop. Looking at the TAC index, the global Baltic air freight index, the BII, it slid negative 6.0% last week.
Yeah.
On paper, that looks like the bottom just falling out.
Right. But I mean, context is everything here. That 6% drop is clockwork, right?
Yeah, factories closed.
Exactly. Planes fly empty or they just get parked. The real story isn't the weekly drop, it's the year-on-year resilience.
Which is surprisingly strong.
Very strong. If you strip away the holiday noise, the global index is only down about 0.5% compared to last year. So the floor is holding.
Mostly holding, yeah. The regional disparities are pretty wild.
Oh, absolutely.
You look at Shanghai, and outbound dropped nearly 7% this week.
Which is expected.
Right, exactly.
Yeah.
But it's still sitting 7.4% higher than this time last year.
Right.
That is a very healthy baseline. But then you look at North America, and Chicago is just in a freefall.
Yeah. Chicago is the worry for sure. It's down 3.5% for the week, which you know is negligible.
Right.
But it's languishing at negative 22.5% year on year. That is not a holiday dip.
No, not
That's a structural loss of volume compared to 2025.
And Europe isn't much happier either. London Heathrow gave back all those massive gains from the previous week.
Yeah, plummeting 17.4%.
Yeah, 17.4. It's basically huge volatility with no clear direction. But amidst all that red ink, the real head-scratcher is Taiwan.
The anomaly.
Exactly.
While Seoul and Bangkok and Vietnam are sliding with the region, Taiwan to the U.S. jumped again. It is totally decoupling from the regional trend.
Which suggests what exactly?
Well, it suggests that specific high-value verticals, likely tech or semiconductors, are moving regardless of the holiday calendar.
Okay, so we have volatile rates and decoupling trade lanes. But the cost side of the equation is getting even weirder.
Oh, yeah.
For those of you listening, we need to talk about this fuel paradox because the economics here just feel broken.
Broken is definitely the right word. We just saw U.S. crude inventories build by a massive 16 million barrels.
16 million.
Yeah, and for context, analysts expected a build of maybe 1.5 million. That is a massive glut of oil just sitting in tanks.
Which in a normal world crashes the price right. Supply goes up, price goes down.
Yet Brent is sitting at roughly $70.85, and WTI around $65.42.
Flat.
Completely flat. The market is completely ignoring the physical supply because of the geopolitical map.
Right, the tension between the U.S. and Iran.
Exactly. That's created a fear premium that's effectively canceling out the inventory data.
So carriers are burning fuel that really should be cheaper.
But isn't.
Because that was pricing. And speaking of government influence, the U.S. Trade Representative just dropped the hammer on tariffs following that Supreme Court ruling.
Yeah, the rate is hitting 15% for certain nations.
Right.
This is basically the new reality of presidential authority on trade. And it's not just air cargo feeling it.
No, sea containers, too.
Exactly. The Port of Oakland is seeing sea containers get caught in this legal crossfire. Everyone is just scrambling, trying to calculate the new cost baseline.
But there is one massive exception, though, which adds a whole nother layer of confusion to this.
Right.
You would think China would be target number one. But the USTR signaled a pause on escalating China tariffs specifically.
It's a diplomatic chessboard. There are visits and talks scheduled, so they're basically holding fire on Beijing while raising rates elsewhere.
Interesting.
Yeah, it creates this bizarre tactical landscape where the biggest trade lane is temporarily the most stable, politically speaking.
So to wrap this up for you listening, the physical cargo is taking a nap for the Lunar New Year.
But the macro drivers aren't.
Right. Oil and taxes are wide awake and incredibly turbulent.
So don't let the quiet data fool you. The fundamentals are definitely shifting under our feet.
And here's something for you to think about while the factories are closed. What happens to this pressure cooker of high fuel and new tariffs once that normal volume floods back into the market next month.
That is the million-dollar question.
Until next time.
Until next time.